Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. This is episode number 137. And our guest for this episode, Dimitri Speck, first became interested in the markets as a child when he found gold while diving at the beach. And even though trading isn't usually as easy as just picking up gold off the ground, Dimitri has spent years diving deep into the markets and uncovering hidden and consistent anomalies that traders and investors of all styles can profit from. In this episode, he's going to share some of these powerful insights with us, including how understanding intraday behaviours can help you to get better prices and additional edge on trade execution. He's also going to share the 4 specific hours of the day that would have given you most of the last 10 years of S&P returns, and it's probably not what you think. Dimitri's also going to explain the one market event that has produced almost the entire S&P performance over the past 20 years in just 6% of the days. He'll also talk about the challenges of accurately measuring these anomalies, which could give you misleading results, the 3 simple techniques traders of all styles can use to apply these behaviours to their own trading, and much more. So let's head on over to our chat with Dimitri. Hi Dimitri, thanks for joining us today. It's really great to have you here.
Thank you very much. It's an honor for me to speak to your audience.
Excellent. Well, so before we get started today, how about you give us a little bit of some background on yourself, how you got started in the industry?
My first experience with the markets was when I was a child. I was diving and I found gold at a beach. And then at that time, I started looking at the gold price regularly. And later, just a few years later, when I became more mathematically interested, I figured out that there might be some market anomalies. And these anomalies, I thought, would be a chance to make quick and easy money through statistics and trends and these things. Yeah, this is how I got started to get interested in the market. And I thought it would be an easy way, but it turned out to be much, much more difficult.
It's not as easy as finding gold on the beach, is it?
Yeah. Also, this was not. This was easy, but of course, the chance is very, very low. It never happened again to me.
Okay. So if we fast forward today, then what type of approaches are you using on the markets?
Now, I use mainly 2 approaches. One is momentum. This is my preferred approach for the commodity markets, and the second is seasonality, which is the main topic which we will talk about today.
Yes. Yeah. So I understand that you're a specialist in seasonality and some other kinds of things as well. What kind of led you down that path to decide that that was something that was worth further investigation?
Seasonality is just an approach which is quite well known, but it's quite rarely traded. And I've spent a lot of time in making seasonal research and making seasonal back testing, and I simply figured out that it is working. It's working with a probability that is high enough to beat the market. And this is why it turned out to be one of my approaches. The second is momentum, which is also working. And so I stayed at these 2 things, which worked for me fine.
Okay, great. Well, let's focus on seasonality for a while then. I think it's a very timely topic considering some of the seasonality things that are coming up towards the end of the year, which I think we'll touch on again very soon. But can you just, we'll start at the very basics. Can you describe exactly what is seasonality? Like, how do you define that?
Seasonality is a trend based on the calendar, to put it simply. If a price has a tendency during a specific period of the year, then it's worth to look at this more in detail. And more generally spoken, seasonality is also applies also to other periods, not only the yearly calendar, but also monthly cycles or weekly or intraday. Yeah. So more generally spoken, and there are quite stable patterns in the cycles which are based on the calendar, and this is why I turned to seasonality in general.
Yeah. So you mentioned there that they're cycles and they're based on the calendar. Can you give us a few general examples of seasonality behaviours that you see?
For instance, as you mentioned, the coming year, end of the year, the Christmas rally is a quite stable seasonal pattern. That it starts in the mid of December and ends at the beginning of January, and it's driven by window dressing, but also by psychological effects like the good mood around the holidays. And it's quite stable. Yeah, in a few trading days, you can really outperform the total market. You have a much higher performance than usually in the markets. And this pattern exists also over many decades. It's not just a fresh pattern. This is one seasonal pattern. Others, for instance, with other cycles, also in the stock market, is the monthly pattern. Most of the returns in the Dow Jones since many decades apply at the turn of the month. Yeah, if you invest only some days before the turn of the month and after the turn of the month, you have even an outperformance compared to the total investment in the Dow Jones. Since 1928, this was a back calculation which I did. So there are many patterns. I just gave you two examples which are quite known, but there are much, much more which are not so good known.
Yeah, okay. So we might get to a couple of those soon. But first I want to kind of ask, how do you go about detecting these patterns of these seasonal tendencies?
So, I do it with charts. Yeah, with seasonal charts. Seasonal charts are an average return based on the calendar. That means you look, for instance, of the last 10 or 20 years, for instance, how the seasonality was of a specific instrument. Yeah. If you look, for instance, for this, of course, you need a specific technology to make these charts. It's mathematically not that easy due to different reasons. For instance, the holidays are on every year on a different day. Yeah. So I was the first one, by the way, who made this charts daily accurate and also price accurate. I published them on my website, Seasonal Charts. Yeah, seasonalcharts.com. And there you can find about 70 or 80 seasonal charts of different instruments. And this gives you a first idea of a seasonal trend. Yeah. So, for instance, if Microsoft, this is an example, rises on October, yeah, you can see this in a seasonal chart quite well. But to go more in detail, you need, of course, the statistics, which I cannot offer on my website. Yeah. But this is how I can identify quite quick a seasonal trend.
Yeah. Okay. And just a little bit more about some of those challenges of identifying and measuring seasonality. I can imagine, say, for example, if you're looking at seasonality in stocks, then you need to worry about stock splits and things like that. And then perhaps if you're looking at futures contracts, you need to think about rollover adjustments and things like that. So what are some of the common challenges that people face when they're trying to identify seasonal tendencies?
Oh, there are many. There are really many, much more than you can imagine. You mentioned two examples. If you use stock prices as input for a seasonal chart or a seasonal statistic, of course, you must look at splits and so on. And if you look for commodities and futures, especially in the field of commodities, but generally of futures, you must look for an adjustment of the futures at the rollover by ratio, not by difference. That's quite important. Otherwise, you have a seasonal effect which exists not in reality. So these are called excess return indices, by the way. Bloomberg has those, and Thomson Reuters has these indices, by the way. So it is possible to make a seasonal chart of a future, but you must really know what you are doing.
Yeah.
These are some challenges. In trading, there are also others, by the way. For instance, if you look at the stock market, and you have something like 1987, which is a specific crash, in October, you might think, is it based on seasonality or not? So you might be interested to filter this out. Or another example, in Germany, we have stocks. I'm a German, by the way. We have a stock called Infineon, which was almost bankrupt and the penny stock in 2009 in the financial crisis. And then it rose by 500 and even more %. So this is not a seasonal effect, and it really makes sense to figure these outliers, to find them and to filter them out.
Yeah, that's an interesting idea. Actually, I never considered that, is trying to determine what's a seasonal effect and what's just the natural behavior of the market. So that must be quite challenging to determine. Yeah,
this is why you should always... the chart gives you an idea where is a good trading opportunity, where's a good seasonal trend. But if you're interested, you should look, of course, at the detailed statistics. That means if you, for instance, look at the year-end rally, you just look at the time, and you make a statistic. How often did this year-end rally apply? How was the medium return? How was the average return? And all these figures, And in the chart itself, you don't see these figures, of course, at the very first moment. You just see, this might be a very interesting seasonal trend.
Yeah. Now you've mentioned seasonality in stocks and in commodities and futures. Do you think are there some markets where seasonality is stronger than others, or perhaps even markets where there is no seasonality that exists?
This is a very interesting question. Many people think seasonality applies only in the commodity markets. I did really a lot of efforts in backtesting with roll forward methods, with taking the code and using it on other markets or in other periods, so that I don't have any overfitting. And my results are quite clear. We have strong seasonalities in the financial markets, in the stock market, in the stock index market, in the sector markets, and the bond market, by the way, as well. And we have seasonality in the commodity markets. What I cannot say for sure is, because of the lack of data, is the seasonality in currency markets. Here we have some strong seasonalities, for instance, at the turn of the year. Usually the dollar drops, or has a tendency to drop, because this has also a quite clear reason, because big companies are shifting a lot of money abroad, to their daughter companies abroad, to avoid to pay taxes. But in generally, there is a lack of data to make it statistically clear that we have good seasonal trends in the currencies. So this is an open question to me, but we have strong seasonalities in the stock markets, in the bond markets, and in the commodity markets.
Yeah. So how much data do you actually like to see to have some confidence that it's statistically viable? As much as possible?
Of course. It depends also whether the markets have a strong correlation. If you look, for instance, at the stock market, the stocks have a strong correlation under themselves. So if the September is typically weak and the year-end rally is typically strong, then most of the stocks do have this behavior. And to find some stocks who have a quite different seasonal behavior, you need 100, 200 stocks, for instance. Yeah. In the commodity markets, the picture is different because commodities have a lower correlation under themselves. Wheat and crude oil often have different trends generally, not only seasonal. And for that, you need less. Yeah. So it depends a little bit.
Yeah. Okay, so earlier you mentioned that seasonality is based on the calendar and that there's weekly and monthly and yearly kind of behaviours. But you also mentioned intraday, which I thought was quite interesting because I think perhaps it's not something people really associate with seasonality is intraday behaviours. So what can you tell us about the intraday patterns that you see?
Yeah, intraday patterns are quite underestimated. And to be honest, it's really surprising that they still exist because there are so many people out which are trading intraday patterns and also with the help of statistics, but still these intraday patterns exist. Yeah. Also long term. Yeah. For instance, we have a better price in the Japanese stocks after the lunch break. Yeah, as an example. So if you know about this pattern, you can just, which is very important for institutional investors, you can just get a small gain to pick the best time of the day when you may place your orders. Yeah, but it's also interesting for day traders. Or for instance, in the S&P, over more than 10 years, you got in the E-mini future, you got the whole return of the index if you were long only 4 hours of the day. By the way, not in the main trading session, but between midnight New York time and 4 o'clock in the morning. Yeah, if you had been invested only in these 4 hours, you got over more than 10 years the whole return of the S&P. So it's really unbelievable that these intraday patterns do exist and that they are so stable. But on the other side, it's also you can understand quite well that these patterns exist because they are intraday anomalies. People behave different after the opening of the market, after lunch break. They behave different, for instance, in Europe when the New York Stock Exchange opens, and they behave different before close. So there are these intraday patterns, and they are surprisingly stable, and you can really benefit as trader as well as, for instance, institutional investor, just to place the order at the right time.
Okay, that's very interesting, and it's also interesting to hear that you say that they're quite stable, because I would have probably had an uneducated guess to say that perhaps they're kind of dying off with noisier markets these days, but it sounds like the statistics prove otherwise.
Yeah, this was surprising to me as well, by the way. I had not expected that these patterns are so stable. Yeah, and by the way, not only intraday effects, they are also intra-weeks effects. Yeah, so we have effects, price effects Monday, Tuesday, and so on. For instance, gold typically rises in between Thursday close and Friday close. Yeah, as example. So also these effects do exist. Yeah, so there are many effects which are not so much considered and which are quite stable in the long run. Of course, they change also. Nothing is forever in the markets, but the probability that they happen again, that they reoccur, is high enough that a trader and an investor can benefit from it.
Yeah. I do actually recall reading an article on your website, which we can talk about later, which mentions that gold study. I thought it was very interesting, so I think we'll share that with the listeners towards the end of our chat today. Now, I just wanted to dig in a little bit deeper about the end of the year seasonal trends. Now, you've mentioned a couple. You mentioned the Christmas rally and also the currencies. Are there any other kind of trends that traders can look out for going into the new year from today?
The most important are the two ones I just mentioned. You just mentioned. Yeah, there are also others which are based on manipulation. For instance, gold is highly manipulated market, and I must look in detail how it's currently. But there was really a period when the gold price had a specific end price of the year, and it was quite clear that there were traders looking that this price is really targeted. Yeah. So there are other patterns, especially at the turn of the year, based on a manipulation, window dressing, based on also bookkeeping, but also based on, which is quite important, planning. Yeah, because companies are planning, or people are generally making their plans for the next year at the turn of the year, and so they make their trading decisions. Yep. For instance, if you look at platinum, palladium, and silver, yeah, these three commodities used in the industry, yeah, for instance, for cars, they are ordered in January and February. Yeah, so you get the best price for these three commodities around the 20th of December. Yeah, and then they typically rise around 10% until the end of February. Yeah, and then nothing happens in average, or some did even drop, like platinum in average seasonal. So you have just here the interesting fact that the industry is ordering after the turn of the year, because they make their plans how much they will order in platinum and palladium, and then the price typically does rise. That's really interesting, and it might also have to do with bookkeeping, that they don't want to have the big orders over the turn of the year. So this is a quite interesting seasonal pattern, which is not well known, and which starts in some 1-2 weeks.
Okay. Now, all the seasonality patterns that you've mentioned, you've kind of assigned a reason to why they exist. Do you think it's important to have an underlying understanding of why a pattern occurs, or is that not really a concern for you?
It depends how you trade. There are different possibilities how to trade seasonality. If you trade only a few patterns, I think it's always good to know the reason. Yeah, if you trade, for instance, in the stock market, many seasonal patterns, you can just let the statistics work for you. You don't need the specific reason for any seasonal pattern in the stock market. I mentioned Microsoft in October, where it's quite clear that there were quite often huge earnings surprises reported at that time of the year, and this was the reason for the rise. But if you look at hundreds of stocks, for instance, you would never try to figure out what the reason for the seasonal pattern is. I mean, then you spend a lot of time. But I think in general, markets, like I mentioned, palladium, platinum, and silver, you should think about what the reason is if you trade this pattern.
Yeah, okay. Well, let's talk a little bit now about the application of seasonality in trading models. What are some of the ways that traders and investors can apply seasonality to the markets?
Yeah, there are many ways to apply seasonality in your trading. For instance, as filter, if you are a short-term trader, you could use seasonality as filter and not to trade against a long-term trend. Yeah, for instance, for a day trader, not to go short when the year-end rally is, as example. But there are many more possibilities to use seasonality or other cycles. For instance, you could use it as one of several input factors in your decision model. Yeah, here in Germany, by the way, we have the best system, which has a real track record since the 90s. It's a quite simple system, and it's not backtesting, it's real track record, and it has one of 4 input factors seasonality. Yeah. So this is one possibility. One more is, for instance, timing. If you are a long-term investor or also a short-term investor, you can use seasonality as timing. For instance, we just mentioned palladium. If you want to go long in palladium or platinum or silver, maybe it's not a good idea to do it at the end of February, but just do it 2 months earlier. Also, one possibility is these intraday effects we mentioned. Even if you are a long-term institutional investor, you don't need to change anything in your decision making. You can just optimize your order if you pick the best time of the day when you place the order, and then you get a slightly better execution. So this is also a possibility how you can use seasonality.
Yeah, okay. And what type of traders do you see using seasonality? Is it purely just like the institutional, or do you see retail traders using these type of approaches as well?
In my opinion, seasonality is every trader and investor can benefit from cycles and seasonalities. This is for me clear because it's just a statistical method which gives you an advantage. And it would be, in my opinion, it's a good idea to use it. It's very simple. This is my general idea. If you want to make money in the markets, you should use statistics. And as long as there are anomalies, I think it's a good idea to use them. Why not?
Yeah. Well, actually, some people I think are a little bit skeptical about trading using seasonal trends. Perhaps they think it's data mining, trying to find the best performing days of the week and things like that. So you kind of just answered this a little bit already just then. But what would be your response to this type of skepticism?
If they don't want to trade them, leave the profits to other people. I mean,
well said. You can't say much to that, can you? Okay, great. All right. Thanks, Dimitri. Now, what would you say to, or what would you recommend to traders or investors who are looking to get started or maybe to expand their knowledge in seasonality?
So I already mentioned my website seasonalcharts.com, where you can find for free about 70 or 80 seasonal charts. Then I offer a free bi-weekly newsletter with picking up several topics. Your readers are your listeners are kindly invited to go to www.seasonux.com, where they can register for this bi-weekly newsletter. And for those of your listeners who are institutionals, they are kindly invited to look at my app Seasonex, which is available in Bloomberg and as well as in Thomson Reuters. Just in the application menu. And there you can really check seasonality for every instrument available. You can apply filters, you can make statistics, you can make much more, for instance, intraday studies or even event studies. For instance, how does a market behave when the futures expire or when FOMC meeting is or when the labor market report comes and. So there are many statistics which are still unknown to the public and which give benefit to the investor.
Okay. If we can just take a couple of minutes now to have a quick chat about event studies, because that sounds quite interesting, some of the things that you mentioned just then. What is some of the interesting event studies that you've observed in the markets?
Oh, there are event studies like I mentioned the FOMC meeting. In the 2 days of the FOMC meeting, the S&P gains in average 0.4 something % over the last 20 years. So you made in just, I think it's about 6% of the days, almost the whole performance of the S&P. So
Wow.
It would be stupid to go long when the FOMC announcement is. Just do it 2 days earlier. This is, for instance, the event study, which is quite interesting. Let's say in front of elections, this is also an event. Typically, the stock market does rise. Because we have in the week before, we because optimism is rising. Also, when the future expiry is in the weeks before the stock market does rise, typically. So there are many, many events which are really interesting, and investors can benefit huge if they know them. I can only recommend to look at them.
Yeah, okay. Awesome. All right, thanks, Dimitri. I might start wrapping up our conversation now with some quick closing questions. The first one, what's the biggest lesson you've learned through trading?
Yeah, for general life, I think trading gives a good lesson because you have to change your opinions. The market is forcing you to change the idea that you have. And this is a good lesson also for life generally, in my opinion. Because the market is really a hard lesson. If you are wrong and you don't change your ideas how to trade, then you are out of the market. Yeah, so you are forced to think over your own picture of the market, or in general terms of the world.
Yeah. Okay. What about what's the best trading advice you've ever received?
This is still diversification, I think. Yeah. It sounds so simple, but let's be honest. Every trading rule can fail. And what is interesting, it can even happen that 2 or 3 things at the same time do fail. Yeah, even if they are not much correlated. So diversification is one thing you should always follow. The second thing might be psychologically. If you are in losses, it's really difficult to psychological factors out and to cut the losses. And the same applies if you are in huge profits. You might get a little bit, you also might get too euphoric and take too huge risks. Yeah, so these are the 2 main lessons or advices which I got.
Yeah, they're great pieces of advice. So thinking a little bit about the diversification topic there, how do you actually manage that with if you're following it like a seasonality models? How do you diversify with those approaches?
There are different possibilities. For instance, one is if you use seasonality as one input factor of many in your trading approach. Another is, for instance, if you use many instruments, for instance, many stocks. And third is where you don't need diversification. If you use this intraday order optimization, for instance, you just place an order at a specific time, don't change your trading approach. That means you get a statistical advantage, and to receive this, you don't need diversification in this case. Yeah.
Yep. Okay, great. All right, thanks, Dimitri. So what's the best way for listeners to get in touch with you? I know you just mentioned a couple of your websites there, but do you want to mention anything further about that before we move on?
Yeah, for seasonality, in fact, my website Seasonal Charts and my website Seasonex are the most important. For if you have Bloomberg or Thomson Reuters in the app menu, you can see these tools, which many features. These are the main things regarding seasonality. I also have written a book about gold, by the way, which has also some intraday seasonalities. It has a title, The Gold Cartel, published by Paragraph Macmillan. So maybe this is for somebody who is interested in the precious metal market and how it's being manipulated. This is something which is available also.
Yeah, and you've also got a newsletter on your website. I think it's called, is it Seasonal Insights?
Exactly. And Seasonex on the website, you can apply for this information and you get it bi-weekly.
Yeah, I do recommend people take a look at that. I've followed that, and it's got some very interesting information and lots of ideas for people to test out for themselves. So I'll put links for all of these up on the show notes page so that people can find them easily, and I do recommend people go and have a look at that. Okay, well, thanks a lot for your time today, Dimitri. Is there anything else that you'd like to mention before we finish up today?
I'm quite fine. Thank you very much. I thank to the listeners to listen. And I strongly recommend for those who are interested in getting statistically advantage to look at this information. And I wish them that they can benefit from them. from it.
Yep. Awesome. All right. Well, thanks again, Dimitri, for your time today. It was really great having a chat to you and sharing your insights into seasonality. So thanks again, and I wish you all the best.
Thank you. I wish you also all the best.
Right. Cheers. Thank you. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.